We're back in your life.
Well, we're kind of back in your life.
We're on holiday.
I'm in Mexico on holiday.
We're on holiday.
I'm in Mexico on holiday. I'll tell you what, the tacos are good.
Yeah, Corona's on the beach.
Margaritas on the beach.
Are they still $1 in Mexico on the beach?
Yeah, I'd say 50 pesos.
Yeah, I'm actually in Sydney, not as cheap, but watching 5 days of cricket. Some people would hate that. I couldn't think of anything better to do. But this episode, since we're on holiday, is all about our best tips from 2024 when it comes to the share market and also the economy. Mike, when I think about our kind of economic takes, there's only one man that comes to mind.
Jarrod Kerr, JK.
And how good is he? He's honestly, every time JK comes and talks, I go, it's not going to be bad forever. I'm sick of this cold winter. He gives me the hope that it is getting better and the data's supporting that.
Yeah, and if you think about the year in full, the start of the year was pretty gloomy, right? The economy was down, forward-looking indicators were down. You know, everyone was having a pretty tough time with those interest rates. Hell, it rained all last summer anyway. But then who spawned into our life like an absolute superhero? Jarrod Kerr, going, you know what, guys? It ain't going to be that bad. Look forward to the end of the year. And I'll tell you what, the sun's out, interest rates are down, and he's telling me it's all going to be good in 2025.
And the other thing is it's not all bad. Like, yes, the New Zealand economy is not in a good place. The property market's not in a good place. Interest rates have been high. But in our quarterly updates we've been doing, the share market, your KiwiSaver balances have been going bonkers. Share market, S&P 500 went up like 30% over the past 12 months. I think for NVIDIA, like 70% of their employees are now millionaires. So there's lots of good things to talk about as well. So enjoy this episode. Much love to Partners Life for sponsoring, and we'll see you next year.
Cheers. Today, we've got Jarrod Kerr, Chief Economist at Kiwibank, back to talk to us about how business is back.
You had some interesting comments before we started filming around that you've been out talking to the people and business owners. And it feels like and sounds like the tide's changing a little bit.
Yeah, a lot. I think the feedback that I've received has been immediate, like surprisingly so. You know, we had a rate cut in August that really woke people up. Okay. Rates are falling. Like that's been a big thing for businesses. Like there was talk not so long ago that they might go higher. We don't know how long they're going to be held at these high levels. Bang, they've been cut. And the conversations that I've been having with business, much more upbeat, much more open to opportunities. Whereas, you know, in July, they all said, look, I've just got tunnel vision. I'm just trying to fix all these problems. Now they're actually looking to next year with a bit of hope.
Why does, like, because maybe the average person listening to this goes, you know, interest rates drop 0.25. Why does that impact a business owner?
Well, 0.25 does nothing. It's a rounding error. It's the direction that they're looking at. It's the future moves that they're factoring in, because we know that 5.5 was really restrictive. So 5.25 is also quite restrictive. Then they delivered 50 when we're at 4.75, still restrictive. They're going to deliver another 50 in November to 4.25, still restrictive. So from the business perspective, they're asking us, you know, are they going to go all the way back to neutral? That's 3. That's a massive move. That is a game changer for, you know, my interest expense as a business.
Yeah. And I think it's probably a good time to talk about why these interest rates matter for businesses so much. And I think you'll find a lot of small to medium businesses in New Zealand are backed by home loans that, you know, once you have a home loan, the decision is really, do I do something or pay off the home loan, right? And it's the same with those business loans. A lot of the business loans are, you know, business owners who have taken out a loan against their property to put capital into the business. And yep, there are a lot of business lending and business loans out there, and they also rely on the cash rate as well. But, you know, that is a real shot in the arm for businesses to say, hey, look, I know it's tough now, but actually, if we're looking 6 months down the track, 1 year down the track, things are going to be a lot better. The economy is probably going to be a lot better. You can start hiring again and get things moving.
You've hit the nail on the head, like absolutely. You know, the small to medium businesses that we deal with are thinking along those lines. They've been hit with very high interest rates and a property market that has contracted, house prices down 18%. So from a business confidence point of view, when you've got a loan like that, you've just been hit really hard. Now you've got an economist standing in front of you saying interest rates are falling and they're falling quite far. And because of that, the property market's going to bounce back. So you've got that double whammy reversing.
Yeah.
And, you instantly start thinking that, the economy is going to improve next year. So as a business, maybe I should start thinking about expanding and investing and doing that good stuff that you just haven't had the headspace for over the last 2 years.
Yeah. And then I think another important point there as well is also the labor market with business confidence. And we talked about in the previous episode that, the labor market was a bit soft. Some of the, wage demands are kind of softened up as well. When business owners are thinking about the future, they're thinking about hiring staff. Would you be saying to them, it's next year, maybe it's a good time to hire now because you can get labor at a slightly cheaper rate? Or
if you have that ability, I would definitely agree. I mean, I think for me, just thinking through the next couple of years, next year is going to be better than this one. 2026 will be better than next year, and so on. So if you do have that ability, for sure.
Yeah.
And what we're telling our customers is get into the bank really quickly.
Yeah.
Do it now.
Yeah.
If you're wanting to do these things, start having the conversation, whether it's with your bank or wherever. Start having the conversation now.
Mm.
And then, when you do decide to pull the trigger in 6 months' time or a year's time, you're already set up.
Yeah.
You've already thought through it. You've already had the advice.
Yeah. And I'm starting to have a lot more of those conversations. We're getting a lot of self-employed people coming to us looking at buying commercial property. I don't know what is going on in that space. We're getting a ton of inquiry about commercial property at the moment, all across the country, not just in New Zealand. I was down in Tauranga on the weekend and went and had a look at a commercial property that a customer was buying as well. And they're saying the same thing. They're like, look, I just need more space because I know the work's coming and I want to be ready for it when the work comes. Yeah.
Right. That's good to hear. Because, parts of commercial property are still in some strife. But I imagine what that means for the astute investor or that is there's opportunities.
Yeah, I definitely think there's opportunities out in the commercial space. The other thing is coming back to New Zealand business owners. It's what is it? 80% of New Zealand businesses are quite small businesses, right? So
I love that you can just say any stat and you just ask Jarrod as if he's going to have
Jarrod,
the answer.
yeah,
you're like Jarrod, this stat. Yeah.
I'm not.
That sounds right.
Yeah.
We are fact checking as we go here.
Yeah.
This is not Trump.
I'm gonna be honest. Jarrod. I've never checked a stat in my life. I'm not gonna start today. But so a decent chunk of New Zealand businesses are quite small.
Yes.
And then at scale, I'm just thinking of the liability as you going it'll get better, get out there, go do some stuff. I'm like, good luck, Jarrod. Hope it works out. But if they go and hire one more employee, across all of these businesses, if they invest in that piece of machinery, there's a huge, one individual business doing that in isolation doesn't do anything. There's a huge ripple effect across the country, right? If everybody does do that little bit of investment.
Absolutely. And, they haven't done it for the last couple of years, right? They've been heads down in a recession. Now, I think because of everything that we've talked about, better outlook, lower interest rates, all of that, better order book, they will start investing that extra dollar or buying that extra machine or getting that extra person.
Yeah.
And that's growth.
Yeah.
That is growth.
Yeah. And if I use Lighthouse as an example as well, right? There was quite a long period of time where we weren't really looking at hiring other people. But now, thanks to obviously the podcast, lots of listeners coming and talking to us about wanting to kind of accelerate their plan. We've run out of desks here. We've hired more people. Then every time we hire more people, right? We need to buy a laptop. We need to go and buy new desks. We need to go and buy chairs. We run out of space. We then go and look at a new office, which has a commercial impact.
Yeah.
When we go to that coffee shop around the corner, instead of ordering 25 coffees, it's then 30 coffees. And you look at the ripple effect across a country, and it gets you quite excited. You have these small things can just have such a big impact.
Absolutely. I mean, I've come in here a few times, and this is really, really quite impressive, compared to when you guys were starting up. And that sort of ripple effect, if there were more businesses like this that we're expanding, looking to expand. Yet that is the economic growth that we're looking for.
Yeah. Today we've got Sam Stubbs, founder of Simplicity, here to tell us his story.
So, I mean, I think you're most well known for your work around simplicity, low cost investing when it comes to KiwiSaver and changing the market. I do want to ask a question about like this. So there's a hardcore passive investing community that would argue that simplicity is not a passive KiwiSaver anymore, just because you're doing too much, right? Would you agree with that?
No, we're mostly passive. I mean, in fact, we are all passive. Let me ask you this. A lot of people confuse passive with being that you don't make any decisions, right? But so, for example, if I have, 90% of our money is in the traditional passive. So it's only 10% we're talking about that we do other stuff with. It might be more over time, but it's still a small amount. But let's use, for example, housing. So say, you're an active manager in housing. Look, if you build and own and rent, with our aspirations, 10,000 houses all around the country, that's a passive portfolio, right? You may have actively built these houses, but our intention is that we will have these large businesses that are not making big bets or anything. They're just doing what I call getting close to the cash, right? So we want to own businesses and assets where it is the last bill you won't pay, right? Because if you also think about, over 100 years, we're going to go through, I don't know, 1 or 2 or 3 depressions, recessions, market blow-ups or whatever. I want our members to own assets where you're still paying the rent, you're still paying the power bill, you're still paying the insurance or whatever. You get close to those big decisions. And if we have a competitive business, so that's a very passive mindset, actually. It just happens that you have to be a little bit active to acquire those passive assets. So I think we're 100% passive myself. Even in private equity, when we're buying these family stakes, if you have 100 of these companies, it's a pretty passive portfolio. Any one of them can go wrong, right? So I think people confuse active and passive. I think that the true intention of passive is that you don't have to worry about any one of these things that goes wrong. So we'll have a very diversified, hugely diversified portfolio of assets, none of which we have to get actively involved in, actually. They just run themselves.
What about the other thing I'm interested in is, so there's a lot of property developers in a lot of pain at the moment who are having to discount stock substantially and essentially move on. It looks like, and you'll know a lot more about this than I will, it looks like it's cheaper to buy a lot of this stock potentially than build it in some instances. Does Simplicity go, there's a lot of new build stock out there in the market. Do you guys think about buying all of that?
Look, we get offered it all the time. It fails on 2 fronts. Most of it we can, in fact, in all instances, we can still build cheaper than buying it. So it hasn't discounted enough yet for that. But secondly, the build quality is often terrible. The building regs in New Zealand mean you have to build a house to last 50 years. If it fell down on the 51st year, you'll get a code compliance on year 1. It's insane. So we build our stuff to last 3 times as long as that, and arguably more. So we don't like the quality of it, and we certainly don't like the price. So I hear. I mean, the building industry, it's crazy, isn't it? This country that has so much land, so many resources, so many builders cannot build cheaply. So we have a system which over the decades has developed into this high margin, bespoke industry where everybody was making money as long as house prices rose, right? Rising house prices papers over a lot of flaws in business models, right? If your assets keep on going, everyone looks like a hero, right? In a rising industry. What we've now had is tides going out. So you're seeing who's swimming naked, right? And it is, and so what we now need, and by the way, in doing that, we also built too few houses. And a lot of that's got to do with successive governments who never restarted the state housing scheme. And, the last government who sort of failed with Kiwibuild. So we have to build a lot more houses, but also got to build a lot more of the same houses. Like in New Zealand, like when we go along to architects, they go, your houses, they're so cookie cutter. Yeah, That's the whole idea,
Yeah.
right? You know, we're running a manufacturing process here. The output happens to be houses, but we're building them like Toyotas, constant improvement. Yeah, you want them to look the same. That's how they get to be affordable. If you want it to look the way you want, your tiles, your sink, your taps, expect that to cost an awful lot of money.
Yeah.
And
I
it does.
heard Chris Bishop get challenged by somebody in the media about that as well, saying like, you're going to have all these like 1-bedroom places everywhere and they're all going to look same and not to be standard. And he goes, well, it's a hell of a lot better than everybody living in tents and in motels, right?
Oh, absolutely.
Yeah.
And you look at New Zealand's history. When we built state houses, right? You know, when you say now, I've just bought an old state house, they go, oh, that's good, because they know it's solid and built. But
And it's still standing.
Still standing. And you know, most of our state houses were built to 3 designs.
Yeah.
Single bay villa, double bay villa. Like you can
You can pick them a mile
recognize
off.
them instantly, right?
Yeah.
They all look the same.
Yeah.
So we've got to get back to mass manufacturing of houses. They were building tens of thousands a year in the state housing boom of the 1930s. You know, it is possible for us to do this. And KiwiSaver is one of those things which will open that up now, because it'll provide the sort of money needed to build in the scale. I mean, you know, when our building program's going full throttle in a few years, we'll be spending $10 million a week on construction.
Yeah.
Today we've got Dean, founder of Kernel, on the podcast to talk to us about if the S&P 500 is a diversified fund.
Now, Dean, I get asked this question all the time.
Mainly by me.
From the finance bros, from the index lovers out there, for the DIYers going, why don't I just put all my money in the S&P 500 and leave it alone? I think Warren Buffett gets quoted a lot in this space going, that's all I would do. What are your thoughts?
Look, it's like the pinnacle fund for particularly index investors that everybody's referred to. It's got a really long history. So, you know, the big famous S&P 500 fund, the SPY, launched 1993. So there's decades of this history. It's the biggest index fund in the US. You know, one fund, the SPY, is 3 times the size of our entire New Zealand stock market, that single fund. So these are popular, well-known, long history funds, and they have proven to be really hard to beat from active managements. So it's no wonder that people gravitate towards them. And now they've kind of become the go-to reference point for any personal finance blog, book, etc. that you may read. And so investors love to look at that as the go-to. I guess the big question is, particularly New Zealand investors, is that where we should be investing? Should we be putting all of our money in the S&P 500, or should we diversify more in what makes up the fund?
Yeah. So as the non-investment guy out of the 3 of us, I'm on the debt side of the ledger. I'm going to ask some questions. James, what is an index fund and what actually is SPY or the S&P 500?
I think this is Dean's world.
Dean, go on then.
An index fund or an index basically just measures the collective basket of some assets.
Cool.
So you can have an index on anything.
Yeah. On us 3?
Yeah, like,
Nice.
you know, it could be measuring your heights and weights over time, whatever it may be, right?
Mike, you have been dragged up. Congratulations.
And so they've been around actually since the late 1800s.
Yeah.
And an index just measures that collective performance. And now there's a million different indices around the world. And you get all sorts of flavors and colors that you like. And so the S&P 500 is measuring the performance of the 500 largest companies in the US.
So
It's
500 largest listed companies
listed
in the
companies,
US.
yep.
Cool.
And so the bigger the company in that index, the bigger the percentage weight it has in the index. itself.
Right. So if you've got, say, 100% is the
the
entire
pot.
portfolio, you know, Meta, Facebook would have a larger slice
Yep.
of that pie than, say, I
So
don't
they're
know.
a more valuable company. They
Yeah.
sit higher up the ladder. And so Meta has a bigger impact in the overall performance
Yep.
every day, because they make up a bigger percentage than, say, company number 500 on the list.
like in and out there.
Yeah.
yeah, and
What's-
so that's an index.
What's happening to like the overall weightings over time? So like there's obviously the stat that the amount of time a company is spending in the S&P 500 is dropping more and more over time.
Yeah.
But is the S&P 500 also becoming less diversified, or have we always had those really big companies and the smaller ones?
So what we talk about, and what I'm sure you guys and everybody talks about when it comes to good investing habits, is diversification. And diversification can get interpreted in a number of ways. For some punters out there, they may be playing around on a trading platform. Diversification to them means, oh, I need to buy every single fund
Yeah.
or every single stock. That's not the case. When you boil it down, what you want is to have a mix of stock. So you don't just want to invest in one single company. So S&P 500 ticks that, right? It's 500 companies, so it's diversified. You want to have a mix of sectors. Like you don't just want to be invested into the construction
tech,
sector
for
or
example.
tech. And so again, S&P 500 invests across a broad range of all those sectors. You also want to be diversified across geographies and countries. What people may not realize was the New Zealand stock market actually was the best performing stock market in the developed world for the 10 years up until about 3 years ago.
Really?
So every year it's kind of random as to which country performs really well, which sector performs really well. And so by spreading your investments across stocks and bonds and sectors and countries, you're ensuring you're going to get a good long-term outcome. And so the question mark where people start going, well, is the S&P 500, is it diversified enough? And should I just put all my money in there, particularly because it's US only? And that's sort of a big question mark because the US makes up about 25% of global GDP. But the stock market makes up 70% of the developed equity markets.
Wow.
So you go on that and say, well, actually, by investing in the US, I'm actually invested in most of effectively the world stock markets anyway. It happens to be domiciled in the US, but these are companies that we all use everywhere around the globe, that the products that we buy from Coca-Cola to using Facebook. So it's kind of global. It just happens to be that they're American companies. So in one lens, the S&P 500 is a fairly diversified asset. But then you do see some other things that have happened recently, which we haven't seen in 50 years, which is the concentration of those top 5 companies. So the 1% out of the 500 is now quite high.
Yeah. And what are those top 5? Like probably Facebook, Apple.
That's got your Alphabet, your Amazon, and I should know this, Apple and
Nvidia
in there now as well. Sorry,
yeah, and commonly known as the Magnificent Seven.
Where
they're just those really big tech companies just continue to grow and take up.
So the 5 make up over 25% now. Top 10's about 35%. So
So
while you're diversified across 500, you're actually still concentrated in quite a lot. Now we haven't seen that since the 70s. So it's quite concentrated. And the big difference as well between when it was as concentrated back 50 years ago was 50 years ago when we had so much in the sort of top 5, top 10 names, they were all in quite different sectors. You had like Exxon and IBM, so energy and tech. Whereas now they're all kind of fairly concentrated into technology-related spheres. So if something happens in terms of an AI bubble or a big tech gets broken up by regulation, etc., you're quite exposed to one kind of theme at the moment.
Yeah, and if you look at the last few years, obviously there's been a huge run on those tech companies and their growth. There's a stat on Nvidia employees, and I think it's like 1 in 3 of them are now a millionaire or something like that because they've got shares in the company, and then 1 in 5 are worth X amount more. So these companies have just gone crazy, but it does make you quite short-sighted because I'm sure a lot of people would be surprised about the New Zealand stat. They're going the previous decade run because you look at the last 3 years and then NZX gone absolutely nowhere.
Yeah, exactly. So if you come back to it, like particularly the fact that we're in New Zealand, I think while S&P 500 is a great fund for somebody to have in a portfolio, it shouldn't be the only thing. And you have to remember that there are always unknowns. And one of the nice things about an index is if you own the S&P 500 or you own a US index over the past 100 years, the performance of certain sectors chops and changes. Railroads used to dominate the index, but then technology has surged. The nice thing about an index fund is that you just naturally own more of the things that start performing better. So you don't have to worry about that too much. But from an investor point of view, having some diversification outside of the US is quite good. It helps protect against all the unknowns that may occur from natural disasters to geopolitical issues, etc. And so that's where people start to actually look at more broader global index funds rather than just a S&P 500.
Today we've got Murray Harris, head of KiwiSaver at Milford, here to talk about active KiwiSaver versus passive.
I'm really glad to be doing this topic today because active versus passive comes up a lot of the time. If people are YouTubing financial education, it'll certainly be something that'll come up. We've had Dean from Kernel, Sam Stubbs from Simplicity come on the podcast, but we haven't had anybody really represent the active side.
Yeah,
and I
happy to
think
be
there's
here.
that saying that like a little bit of information is like more dangerous than no information. So it'd be good to kind of talk about both sides.
Yeah.
So where do we want to start, Mike?
I reckon let's go. Let's break it down for everyone, right? What is active management and what is passive management? Just in a nutshell.
Yep. Well, look, I kind of start by saying both are very valid ways to manage money,
Yep.
right? And you tend to find that there are proponents for one or the other. With active management, as the name suggests, you've got an investment team, which is normally a team of, highly skilled professionals that are well trained, actively choosing every investment that goes into a fund or a portfolio. And in the case of KiwiSaver, it's your KiwiSaver fund,
Yeah.
right? So you've got an investment team who's doing bottom-up research on each individual security and investment that goes into those funds, as well as making a decision around which asset classes to be in. So how much do we want to have in shares versus bonds versus cash? And in fact, that actually can be the biggest lever rather than the individual securities that you choose. And so an active manager is trying to pick the winners
Yep.
and avoid the losers, because sometimes the best decision you can make is where not to invest, not where to invest.
Yeah.
In passive, as the name suggests, there is no active investment decisions being made. So it's a passive investment. Generally, the investments are made in an index fund or an index tracking fund. People will be familiar with those terms, or sometimes an ETF, an exchange traded fund. And those funds will just have exposure to the entire market.
Yeah.
So let's say it's the US share market. There'll be an S&P 500 or a Dow Jones index fund, and it will have exposure to every single company in that index, regardless of whether that's a good company to invest in or not.
And then in terms of the way that Milford operates, you've talked about the research and the team and, kind of the way that you guys perform your investments. You've got to consistently outperform the market, to justify the fees and especially compared to the index guys. How do you guys do that? What does that look like? And what's the type of the ethos that Milford has behind that?
Yeah, well, you did right. I mean, why would you pay an active manager if they can't beat the market, right? And look, there is a lot of research out there which says active managers can't beat the market. We're very aware of that. And look, that is probably true in some of the very deep and efficient markets like the US and some of the European markets where, there's a lot of information out there. They're very liquid and deep markets, and it's probably harder to beat the index. In New Zealand and Australia, we can get very close to companies. We can, like any company on the NZX, our team could pick up the phone today and have a conversation with the CEO, the CFO. We can go down and meet them. We can talk to them. Obviously, we can kick the tires pretty hard. We can get a really strong picture of the business as well as the competitive environment and, talk to customers and all that sort of stuff. So you can build up a really, really strong picture. And so there is actually evidence which shows active managers in less efficient markets like New Zealand and Australia can outperform. And, there's research done by Melville Jessup Weaver. They do some very good research. They're an asset consultant, and they produce a quarterly report. And it shows that active managers have performed, in particular New Zealand, Australia, outperformed the index and the market.
What about when it comes to so that's interesting in terms of the Australia New Zealand component, active versus passive, but you still look at it and there's active managers who do not outperform the market and who are pretty far behind. And you look at the Morningstar report that comes out on a quarterly basis and stacks all of the KiwiSaver providers, and Milford since 2007 has this their numbers. You look at the stats around active versus passive and the probability of outperforming the market over the long term. Coming back to Mike's question, how does Milford continue to outperform?
Well, actually, if you look at that Morningstar report, the September quarter one just came out, and if you look at in the growth category over the last 10 years, the top 4 performing funds are all active managers. And over 5 years, I think it's the top 3 are active managers. So, passive's done better in the last 12 months because the market's just gone like this, right? So, a rising tide lifts every boat. And so the passive funds have actually done very well in the last 12 months because they've ridden the market up. But can they maintain that? You know, if the market goes through a downturn, as an active manager, we're trying to manage the downside.
Yeah.
Right. So it's easy, not easy, but it's easier to make money when the markets are on the rise. For us, it's about picking those individual companies, picking the winners, and managing the markets on the downside. And that's really where an active manager will earn their fees. And so for us, again, it's just a very consistent, repeatable, robust process that we go through managing our clients' money. I think one of the other big things for Milford is that we're all invested in the same funds. Every single staff member at Milford, or the investment team. We can't have our money anywhere else.
Yeah.
And so, you know, there's quite a bit of motivation to say, hey, we've got to do well for our clients, but we've got to do well for us. And it's our mums and dads and aunties and uncles that are in there as well.